Financial Futures, a podcast by Van City.
Hi, listeners. Welcome to another episode of Financial Futures, where we break down complex financial concepts into bite-sized pieces for the everyday person. I am your favorite finance student and beloved host, Ben, and today we will be diving into the exciting world of investing. Joining us today is another very special guest from UBC Sauder, Jyotsna. Welcome, Jyotsna.
Thank you for having me, Ben. I'm thrilled to be here and share some insights into the world of investments.
Fantastic. So let's start with the basics. What exactly is an investment, and why should our listeners care about it?
Great question. So, an investment is essentially any asset or item that you could acquire with the goal of generating income or appreciation in value over time. It could be anything from stocks and bonds to real estate or even collectibles. The main goal is to put your money to work now in the hopes of getting more money back in the future.
That makes perfect sense. But it seems like there's so many options out there right now. How do people know where to start?
I think it really depends on your financial goals, risk tolerance, and time horizon. For beginners, I often recommend starting with something simple like stocks or bonds. Stocks represent ownership in a company, while bonds are essentially loans to governments or corporations. Both of these can offer potential for growth or income and come with different levels of risk.
So we've briefly gone over a few different types of investments, but can you walk us through the most common ones that we'll see today?
For sure. I think we'll start off with the basics, that is stocks, also known as equities. So basically, when you buy a stock, you're buying a piece of ownership in a company or a stake. This means you're entitled to a share of the company's profits and potentially voting rights on certain matters. Stocks can offer great potential for growth, but they can also be very volatile. That is, they tend to fluctuate with the market.
So it's like owning a piece in a company. That's quite interesting. And what about bonds?
Bonds are essentially loans that you make to the governments or corporation. In return, they promise to pay you back the principal amount plus interest over time. Bonds are generally considered safer than stocks per se, but they are backed by the issuer's ability to repay and have lower returns.
I see why they're called fixed income now. That makes sense. So let's talk about a few different types of funds, index and mutual. How do they fit into this picture of investing?
That's a really great question. Most people tend to get really confused with these terms. Firstly, index funds and mutual funds are great options for investors who kind of want to diversify their portfolio without having to pick individual stocks or bonds. Because a lot of research and time goes into picking individual stocks or bonds. These funds basically pool money from multiple investors and invest it in a diversified portfolio of assets. Index funds simply track a specific market index while mutual funds are actively managed by professional fund managers. So basically, they do all the work for you.
Wow, that really sounds like a convenient option for those who don't have a lot of access to research or don't want to do the research themselves. Now let's talk about real estate. I know this is an important topic in Vancouver. How does investing in real estate work?
Um, Real estate investing involves purchasing properties with the intention of generating income. This could be through rental income, property value appreciation, or both. The best part is that real estate can be a great way to diversify your portfolio and hedge against inflation, but it also requires a significant upfront investment and ongoing maintenance.
I see. Let's talk about something a little bit different than what we've already touched on. How about commodities or cryptocurrency? How do they fit into this broader picture of an investment landscape?
That's a great question. So, coming from the Middle East, I think this is the perfect question that fits into my background. So, commodities like gold, oil, and agricultural products can be a good hedge against inflation and geopolitical instability, something that the world's been facing often. They tend to have low correlation with traditional financial assets like stocks and bonds that we touched upon earlier, and that can help you diversify your portfolio. In terms of cryptocurrency, on the other hand, it's a relatively new asset class and it has gained a lot of attention in the recent years. It offers potential for high returns and also comes with high volatility and regulatory uncertainty.
Well, I can definitely understand the commodities part coming from Alberta, but I'm still a little skeptical on cryptocurrency. And there's certainly a lot of different options to consider when looking at investing. Now, before we wrap up, do you have any final tips for our listeners who are thinking about getting started in investing for the first time?
No, absolutely, Ben. The most important thing is to do your research and understand your risk tolerance. It's important to start off with a solid financial plan, set clear investment goals, and stick to your strategy even when the markets get turbulent. And remember, investing is a long term game, so be patient and stay up to date with market events. And that's how you can win big.
Very wise words. Thank you so much for joining us today and sharing your insights.
Thanks, Benjamin. Really appreciate you having me today.
And that's a wrap for this episode of Financial Futures. Join us next episode as we welcome special guest Matthew to help demystify one of the most important topics in finance, credit. Look forward to another spirited discussion, and until then, make sure you invest in your future.